You have now learned the concepts of life insurance premiums, proceeds, and beneficiaries. Let's review some of the key areas from this section that will help you prepare to pass. Calculating premiums. Once an insurance company determines that an applicant is insurable, they need to establish an appropriate policy premium. The premium will be used to cover the costs and expenses to keep the policy in force. There are three primary factors used in determining premiums: mortality, interest, and expense. Mortality. The term mortality means the rate of death. Mortality tables help insurance companies predict life expectancy and the probability of death for a given group. Interest. Since premiums are paid before claims are incurred, insurance companies invest the money in an effort to earn interest. This interest is a primary factor in lowering premium rates. Expense. Just like any other business, insurance companies have operating expenses. These expenses are factored into the premium rates. This is also known as the loading charge. Death benefit proceeds. Death benefit proceed, also called settlement options, are the methods used to pay the death benefit to a beneficiary upon the insured's death. The policy owner may select a settlement option at the time of the policy application and may also change that option at any time during the life of the insured. Once selected by the policy owner, the settlement option cannot be changed by the beneficiary. The following are common death settlement options. Lump sum cash option. Upon the death of the insured, the policy is designed to pay the proceeds in cash, called a lump sum. As a rule, this lump sum is not taxable as income. Interest-only option. With the interest-only option, the insurance company retains the policy proceeds and pays interest on the proceeds to the recipient beneficiary at regular intervals. The insurer usually guarantees a certain rate of interest and will often pay interest in excess of the guaranteed rate. Fixed period option. Under the fixed period option, also called period certain, proceeds will be paid out in equal installments over a specified period of years. Fixed amount option. The fixed amount installment option pays a fixed specific amount in installments until the proceeds are exhausted. Life income option. The life income option provides the recipient with an income that he or she cannot outlive. Installment payments are guaranteed for as long as the recipient lives. The amount of each installment is based on the recipient's life expectancy. 1035 exchange. In accordance with Section 1035 of the Internal Revenue Code, certain exchanges of life insurance policies and annuities may occur in a non-taxable exchange. When a cash value life insurance policy is exchanged for another cash value life insurance policy, or an annuity for an annuity, there will be no income tax on these transactions. Beneficiaries. Who can be a beneficiary? There are very few restrictions on who may be named a beneficiary of a life insurance policy. The decision rests solely with the policy owner. A beneficiary is the person to which the policy proceeds will be paid upon the death of the insured. Beneficiary could be individuals, businesses, trusts, estates, or even charities. Types of beneficiaries. Primary. The primary beneficiary has first claim to the policy proceeds following the death of the insured. The policy owner may name more than one primary beneficiary, as well as how the proceeds are to be divided. Secondary. The secondary beneficiary, also called the contingent beneficiary or tertiary beneficiary, has second claim in the event the primary beneficiary dies before the insured. Contingent beneficiaries do not receive anything if the primary beneficiary is still living at the time of the insured's death. Per stirps. Per stirps, which means by the bloodline, distributes benefits of the beneficiary who died before the insured to the beneficiary's heirs. Per capita. Per capita, which means by the head, evenly distributes benefits among the living named beneficiaries. Changing of the beneficiary. Revocable. The policy owner may change a revocable beneficiary at any time and without the knowledge or consent of the beneficiary. Irrevocable. The policy owner may not change the beneficiary without written consent of the beneficiary. The policy owner also cannot borrow against the policy's cash value. Special situations. Uniform Simultaneous Death Act. Under the Uniform Simultaneous Death Act, the law will assume that the primary beneficiary died first in a common disaster. This is done to make sure the contingent beneficiary receives the death benefit proceeds. Spendthrift Trust Clause. The Spendthrift Trust Clause prevents the beneficiary's reckless spending of benefits by requiring that the benefits be paid in fixed installments. Fully understanding the key topics just discussed is essential as you